Hello, everyone. Welcome to Real Estate Right Now. We talk about real estate matters that matter to you. My name is Jay Izzo, and we are live here from Linden Craft King Studios here in Raleigh, North Carolina, part of the Greater Research Triangle Park. Today's show, taxes in real estate. Ooh, ooh, ooh. First of all, we all know the saying, right? There's two things you count on: death and taxes, right? But how can we save you money if you're a homeowner? Right? Or if you're going to buy a home, things that you should know. So I needed to bring in an expert because the last thing you want me to talk about taxes is me. So I bring in Bill Bourbonnais from Bill Bourbonnais Tax Associates. And you've been doing this how many years now?
Going on 30.
30 years.
30 years, yes, sir.
Wow. Okay. So 30 years. I like calling you're a tax guru, tax expert, tax coach, tax specialist. I think all those things apply to you.
All of them apply.
And they've been great. Well, the thing that when it comes to taxes is that I'm going to get right into the meat and potatoes of it, is people want to know, well, how much of a tax savings is there if I own a home? So what do you tell people by owning a home? What kind of tax advantages, or how important is it?
It's very important because, of course, first off, you're putting a lot of money into probably what is the biggest investment of your life.
Sure.
So our tax code is written for investing and for business expansion and those kind of opportunities. So when you're buying a home, when you're going from renter to homeowner, some of the things you might want to look at are the mortgage interest on your loan. So take a look at that amortization schedule that's part of your closing package. Mortgage interest up to $750,000 for a primary residence is deductible if you itemize your deductions. So part of that payment that's going out every month is a tax deduction for you. That's probably the biggest tax advantage you're going to have in buying a home.
Okay, so I understand that I can write off my interest, but when I'm doing my itemized deductions, but what percent? I mean, I can't write. Not all of that is going to be able to be written off. Is that true? Or
right, just the interest portion. So when you look at the amortization, usually it's going to have principal,
right,
paying down the loan itself, and then the interest that your mortgage lender is going to charge on that loan. So the interest portion is deductible. The principal is paying down the loan. So eventually, that's how you increase your equity in the property.
Right. So I guess my question is, when the IRS looks at it, right, and you go, okay, I got all this interest, are you able to write off every cent of that interest, or do they go, no, you only get a percentage of that to write off interest?
For this changed in the Tax Cuts and Jobs Act back at the end of 2017. So up to $750,000 of mortgage, all of that interest is available to be written off on your Schedule A. Now, I put a caveat on there. If you do go out and get a HELOC or cash out refi, the loan proceeds have to be used to buy, build, or substantially improve your home to be deductible. So this trips up some people. Sometimes they get that equity. They go out, take a HELOC, and then they buy a boat or want to do some play things. Well, that interest is no longer deductible. But that primary mortgage, those interest payments, let's say you're in a 22% tax bracket, for every dollar that goes in to interest, you're getting 22 cents back from tax savings.
Okay. Let's go to the first-time home buyer. Okay, first-time home buyers, they get into their home, they're excited, they think about, oh man, I got my first home, this is awesome. But then, you've got to think about, well, you've got something here that you can take advantage of that can help reduce some taxes. If you were to advise a first-time home buyer when it comes to buying their first home, and you were to say to them, here's what I want you to start thinking about looking at when it comes to for your taxes down on April 15th, what do you tell them?
I do want you to make sure you're tracking your interest. The lender is going to give you a 1098 that reports that, but let's look at maybe some timing opportunities. Let's say under the Tax Cuts and Jobs Act, a lot of people no longer itemize because they doubled the standard deduction. But that doesn't mean you're stuck with that standard deduction. If you play the timing game, you maybe pay your January payment in December because you're right at that cusp. Now that interest on the January payment gets pulled into a different year, and then you could possibly maximize that deduction for a year where you can itemize, and then the next year you take advantage of the standard deduction. So there's strategies on how to time your payments and take full advantage of that. And of course, the property taxes that you pay to the county as part of home ownership, that also becomes a deduction on your Schedule A when you itemize.
When you are sitting down with that first time home buyer who's never done this, what are some of the other tax questions they may ask you just outside of interest? Interest. Are there some other things that they say, well, Bill, is there anything else that I could take advantage of in my home? Is there any sort of tax savings? Because I got this home. I know I'm paying on most interest here up front because, I know how the amortization schedule works. Most of it's interest and it's a little bit of principal. What are some other pieces of advice that you give that first-time home buyer with regard to taxes?
Typically, those are the primary things that we're looking at. But also, you want to look at, well, what is their projection? What is their end game? We do look at. We've got a lot of people that are kind of in the gig economy, maybe have a part-time side hustle. Are they working out of home? We want to look for advantages there because they can potentially deduct a home office. If we've got somebody that's doing crafts and things that they're selling at Etsy or at a market, if they're storing their supplies or storing their product in the home, that's another home office deduction.
Really?
Yes, you can deduct storage. You can deduct the regular office space that you're using to run your business. So there's opportunities there as well.
So let's talk about the home office piece because I have a studio in my house and it's exclusively for that. It's my office. It's my studio. Mostly it's for my other show that I do. And it's you go in there, it's like this, the microphone and the monitors and the whole thing. How much of that can I write off?
Well,
or can I get a tax savings?
You can get a pretty decent tax savings because here's the key. It's got to be regular and exclusive, which you just said that's where you run your business. That's where you run your show.
Yeah.
So for a home office, you're able to take a percentage of your mortgage interest, your property taxes, utilities, anything that's a general cost or expense for your home, and take that percentage for the home office as a business write-off. So that's effectively, you're not losing anything there. You're taking money from one column where it's not deductible and pushing it into a column that is deductible. You're going to spend the money for those expenses anyway. But now we've turned it into a tax advantage. You can also take some depreciation on that home office percentage as well. So like a real estate investor who can depreciate the property that they've bought and they're renting out, you can take advantage of the depreciation on your home office as well, which is a non-cash expense. And again, gives you another tax advantage for that home office.
So let's take the home office, for instance. Okay. So like I've got, the board, the big soundboard that's cost me a lot, the microphones, all of the gear that I have to set up that studio in there. I can depreciate those as well, is what you're saying?
Yes. Any equipment that's used in your business that's legitimately part of your operation, you write those off. Another thing about some IRS changes that came about probably 10 years ago is if it's $2,500 or less, you don't have to depreciate it. You just write it right off. It's called the de minimis safe harbor. And if it's 2,500 or more, then you depreciate it. So your sound equipment and your screens and everything, typically probably looking at 5 or 7 year depreciation. We also have bonus depreciation, which is part of an accelerated write-off. So in that case, well, up until this year when the bonus depreciation was reduced, you were able to write off 100% all at once and not have to worry about tracking 5 years of depreciation.
Can a renter take advantage of that if they have a home office?
Actually, yes.
Really?
A lot of tax professionals don't pay attention to that. They skip over it.
Right.
But the key to the home office deduction is it regular and exclusive. And if you're using TurboTax, oh, please don't use TurboTax. But anyway, if you go through and do your own tax return, or if you even get the publications from the IRS, Form 8829 is what's used for your home office expenses. And you're either listing out your mortgage interest or you're listing your rent payments and then allocating that by a percentage. So renters can take advantage of the home office as well.
Let's talk here a little bit about the seller side.
Okay.
So seller is going to sell their home. What can they take advantage of?
The biggest thing they can take advantage of this is incredible in the tax code. It's wonderful. It's called the Section 121 exclusion. So a married couple filing jointly, if you have, say, gain on the sale, you've built up some equity and you've had appreciation in that property, you can exclude up to $500,000 of gain from your taxes right off the bat. If you're single, that's $250,000 exclusion. So kind of put that in perspective, you're effectively taking $500,000 worth of Apple stock or some other stock on the market. If you sell that, you're going to pay roughly about 20% in tax on capital gains taxes. You've now got a free chunk of income from selling your home that's not subject to capital gains taxes. So you take that appreciation, you cash out. That's money you can use for anything you want. A lot of sellers, of course, use it to either step up, step down, whatever their goal is. But if you want, take a portion of that, buy a new home, and then take a portion maybe to start investing in real estate. The Section 121 exclusion is a tremendous opportunity to build tax-free wealth.
So what have you seen people do with that to take advantage of that most? Is it mostly purchasing another home, or have they used it in another form that you've seen that they take advantage of?
I've seen both. A lot of them will drop a pretty good chunk of it into a new home to buy down their mortgage effectively. But some do get into smaller real estate investments, single family properties. We're seeing a lot of people getting into short-term rentals, Airbnb type rentals, which is another tax advantage we can talk about another time. But there's some good tax advantages there as well. But even paying for the kids' tuition in college, opportunities there to use tax-free money on things that you'd be really taking out of your paycheck to pay for.
Well, I'm going to kind of move into it because you kind of alluded to it a little bit, but you talk about a 14-day, I can rent my house for like 14 days or something.
Oh, right. The Augusta Rule.
Yeah.
That's a fun one. So the Augusta Rule, it's named after the Masters tournament in Augusta, Georgia, that happens every year. So what we have in the tax code is an opportunity for you to rent out your home up to 14 days a year, completely tax-free. Any money you get from that in your pocket. So I don't know if you've ever looked at the rental rates for private homes in Augusta during the Masters tournament. Some people are getting $3,000 a night. The same thing happened in Phoenix several years ago when we lived there and we had the Super Bowl. People were getting outrageous sums of money for renting out their home. They go off and take a vacation. Now their home is being rented out tax-free for up to 14 days.
So honey, I don't think we can rent our home for $3,000 a day, but if we can, I'm open to going away for 14 days. Okay? So I can rent the home for 14 days.
You can
tax-free.
Rent the home for 14 days tax-free. Here's another twist for any of your audience that are business owners.
Right.
The Augusta Rule, you don't have to rent to strangers. You can rent it to your business if you have a corporation or a partnership.
Really?
As long as you've got a separate entity, you can use your home, rent it to your business to use for directors meetings, to use for training sessions, have situations where maybe you bring in clients, customers, or prospects for some education. The only thing you don't want to use it for is like a entertainment party or something like that. It throws it into a different category. But that way you've got the opportunity to rent your home for tax-free income to somebody your own business.
Okay, so I just want to be clear. If I want to, for instance, I want to do a training session and I want to do it in my home, and I have a business that is a training business, which I do, I can actually do that in my home and I can rent that back to my business.
Yes.
Is that correct?
That is correct. You want to be careful that you're documenting what rate you're using.
Right.
But let's say you go out to a virtual office company and you rent their conference room and you have them provide the food and everything. That's a pretty good benchmark for a daily rental rate. And I've seen some of those get pretty decent, $500, $700 a day, which isn't too bad for tax-free money.
Right.
So it's a write-off to your business, tax-free income to the homeowner, and the opportunities there. And again, you need to be careful about what standards you're setting for that rental rate. So there was a recent tax court case. It didn't shoot down the Augusta Rule. That's locked into the tax code. But the tax court and the IRS said, no, you're charging exorbitant rent rates and we're going to disallow most of it.
I don't know if this is appropriate or not, but I'm going to do it anyway. Just because it starts to sound a little Airbnb-ish, in that, you're renting your home. And of course, when you're Airbnb, it's a different category. But maybe we should talk about here, if you take your home and turn it into an Airbnb, what are some of the tax advantages there that they can take advantage of as an Airbnb if you use your home that way?
Okay. If you are using your home as an Airbnb, you've still got that 14-day opportunity if it's still your primary residence. If you're stepping out of it as a home, going into a new home, and you're converting that to an Airbnb, the difference between a single family traditional rental unit and an Airbnb, as long as the average stay of your guest is 7 days or less, it puts it into a different category. It changes it from passive income to potentially active income. And the thing about that, if you're meeting the participation tests that IRS has 7 potential tests you have to pass to get this qualification, then any losses you have from that Airbnb through, for example, depreciation, you always want to cash flow, but depreciation, because it's a non-cash expense, can help push that for tax purposes to a loss. Normally, a rental property won't offset your W-2 income. An Airbnb or a 7-day short-term rental will. That can offset your W-2 wage income. And now you're getting rent income, taking advantage of the depreciation, and reducing the tax hit on your earnings from your job.
So the Airbnb thing, which is very popular with people because oftentimes they live in their own home and then you're allowing the other people to stay in the home while they're still living in it. I've been in the Airbnb, been in Airbnb where the homeowner is there. They rent out the rooms and then they're still there. So that 14-day tax exclusion you can still use that.
You can use that for the non-Airbnb section. And then on the Airbnb, you're essentially doing what's called house hacking there.
Yes.
So you're splitting out a room or set of rooms, or maybe you've got a basement that's furnished and you're renting that out as an Airbnb. So we've got a different income stream, a different business operation there. And then in the main part of your home, if you still want to use that 14-day Augusta rule, you can, as long as we're separating the two.
I gotcha. So, okay, well, this is really good information because I think people who want to turn themselves into an Airbnb, we don't want to get that confused there about the 14-day exclusion, because you're living in the home and it's really a business at that point once it gets really past that, and you have to be careful what even though they have access to the entire home, they're living in the bedrooms, or does that matter?
No, you want to be renting out the bedrooms, and then of course you do have the shared facilities of the kitchens.
The shared areas. Yeah. Right. Okay. We talked about separate entities. I want to get into this for a little bit. There have been some national tax advisors or money advisors, if I will, not mentioning any names, who have said, put your properties into an LLC, right? To protect yourself, obviously for a variety of reasons. Right. But you don't agree. There's one exception to that.
There's one very definite exception. We talked about the Section 121 exclusion, where you can effectively get tax-free income from the appreciation of your home. If you put your home into an LLC, that can just destroy that opportunity. Now, if you're a single person, put it into a single member LLC, you can still get that 121 exclusion. As soon as you have any other individuals that are members of that LLC, now it's no longer the individual that owns the home, it's the LLC, and everybody shares that. So that 121 exclusion goes away. I had a client that did that. They put their mother's home in an LLC. All the siblings were members of the LLC. Mom sold the home. Unfortunately, she didn't get the 121 exclusion because all of the siblings were also owners of the home.
So, okay, so don't put your home in an LLC. Thank you, Joel, for tuning in. Don't do that. Some people want to have investment property. There's this thing out there called the 1031 exchange that we throw around a lot, but I think is a little misunderstood. Give us some clarity of what a 1031 exchange is in terms of investments and how that actually works.
Okay. 1031 is a really cool part of the tax laws around real estate investing. Have you played Monopoly?
Yes, love it.
You've done 1031 exchanges. You go around the board, you buy land,
Right.
you build a house.
Yes.
You build 3 more houses.
Right.
You're charging rent, you're getting passive income. You got those 4 houses,
Yeah.
you trade them for a hotel.
Mm-hmm.
So you've done a 1031 exchange on Monopoly. So what a 1031 exchange is you take one investment property you have, and instead of selling that, getting the capital gains hit on your gain on the sale and putting the money into a new property, you trade that real estate for a new piece of property. Now your basis in the old property is going to go into the new property. So your basis is going to not necessarily increase unless you put more money into it, but you've effectively avoided that capital gain hit, and you've increased your holdings, you've increased your real estate portfolio, and you can continue to do this on and on and on. And here's a cool part about estate planning. Are you familiar with the step up in basis?
Yep, let's talk about that.
Let's talk about that. So 1031 exchange, you're deferring those taxes, those capital gains taxes. Eventually, you've got an incredible real estate portfolio. Your heirs, when you pass, if those properties pass on to them, get a step up in basis to the current fair market value. You've just eliminated capital gains taxes on all that history of appreciation of your property. The caveat there, if it's not in an LLC, this works. If you put it into an LLC, they get a step up in basis in the LLC, not in the property. But this is a great way to strategize both your portfolio expansion and your legacy planning for your kids and your grandkids.
So note to everybody out there, an estate plan is a huge deal.
It's a very huge deal.
And especially how we set that up. They need to talk to you before. If you got multiple properties, they should be talking to you first. Right. About what we're doing here, what your intentions are, what your goals are, so that you're not crushing your heirs right with taxes, right? Because we can help there as well. Is what I'm hearing is talk to Bill first, right? And before you even start thinking about moving those properties into your state, so that you make sure that you're protecting them. That's what I'm really hearing.
Absolutely. You need 4 key players on your team. You need your real estate professional. You need your attorney, you need your tax guru, and you need your estate planner. Those are going to be the keys to keep you out of trouble when you do have that estate come due and your heirs are inheriting property and they're not getting caught up with something that gets trapped inside of an estate tax return at 40% tax rate when they could have paid either 20% capital gains or no capital gains.
Right. Believe it or not, we've done our time.
Holy smoke.
I told you.
You did. You warned me.
I told you this is going to go really fast. If you want to put a bow on it, what would you say? Put a bow on all of this when it comes to taxes.
There's the bow I would put on there is there's a lot of information in our tax code. Real estate is one of the industries out of a total of 8 or 9 that are specifically have sections of the code written for it. So if you're interested in real estate, definitely take a look at that. There's a lot of great opportunities to save taxes, a lot of great opportunities to do estate and wealth planning, and it can diversify your portfolio overall.
Awesome. And then tell the audience how they can get a hold of you.
Great. You can drop me an email at bill@yourrealestatetaxpro.com, or you can give us a call at 919-803-6468.
Now, we have a thing on podcasting and TV and radio that you got to say your phone number more than once. So give them that phone number again. 919-803-6468. Perfect. Bill, it's been great having you. Thank you so much.
My pleasure.
This has been a lot of fun. And and by the way, folks, if you saw the notes that he gave me, there's a whole lot more we could have talked about that we didn't. But thank you so much. Stay with me. Hey, folks, this is the show. You had a lot of choices. You chose us. Thank you so much. Give us a thumbs up on YouTube. If you're listening to us a podcast, you know what? Do us a favor, right? Give us a 5-star review and tell us what you think. And then, if you want to ask us a question or you have a guest that you'd like to be on the show, here's the best way to do that. Just go to service@lindacraft.com. That's service@lindacraft.com. Say, hey, I have an idea for a guest on the show, or I would like to have a guest on the show that would talk about this specific information. We would love to do that for you. So give your suggestions. If you have a suggestion about the show, even if you don't like the color of my suit, say it. We're okay with that. As I say to you all over the world, you know what that is. And I thank you again. Ciao, everybody.